Welcome, ladies and gentlemen. My name is Dustin Kircher with MHP Nation. I got my partner here, Ben Dreiser. We got an amazing guest today, Mario, who's going to be talking about his experience in, 15 years in this business. He's got over 1,000 pads in the manufactured homes spot. He's also got a bunch of self-storage properties. He's vertically integrated in all kinds of different businesses within this space. So I'm excited to bring him on as our guest today and ask him some questions about his experience and his growth. It looks like he's got an amazing background. Ben's been able to talk with him. I'm getting to know him and meet him for the first time here. So I'm excited. I'm like a little kid in a candy shop getting ready to think of all these questions to ask him. But without further ado, welcome, Mario. Appreciate you being on our show.
Ben, Dustin, this is a pleasure. Thank you so much for having me on. I'm really excited to hang out with you guys. Usually on interviews and everything, I only get, hit by one person with a bunch of questions. So just bring it. I'm in the hot seat and I'm looking forward to adding as many or as much value to your listeners as possible. So I'm excited to be here and love what you guys are doing with the show.
Nice. Well, we appreciate you coming on. I know you're a busy guy. As we were just talking before hitting record, that you had some last minute business to take care of. So we appreciate you coming on.
21st mortgage documents to be
Yeah.
notarized and signed last minute. Yes, I'm sure anybody listening to this would understand what that means.
Yeah, very cool. So how long you been in this mobile home park space? I know I kind of mentioned it since 20, what was it?
So I started out in real estate. Shoot, it's been 16, maybe going on 17 years, and that's probably what you were referencing.
Yep.
I've been in the mobile home park space for going on 10 years now, a little over 10 years.
Nice.
And I bought my first park in, I want to say it was 2014, something like that. And I've bought storage right around the same amount of time, but the focus has mostly been on mobile home parks with just kind of a side acquisition here and there of storage. Parks are really my passion, like I'm sure it is for you, something that's done very well for me. And I'm thankful for it. Yep. But if you want, I can tell you how I got into it.
Love to hear that story. Yep.
Cool. All right. So here's the thing. Everybody thinks, graduated from college. I never went to college. I barely graduated high school, and definitely not the guy that you would have expected to be in real estate, let alone finance or commercial real estate back growing up. But what I learned is that opportunity will take you in a lot of different directions that you never anticipated if you're willing to chase it. And I was in the single family business back in 2008. I owned a real estate brokerage with a partner, and we all know what happened in 2008. The market tanked, and my dad happened to be in construction his whole life. He was a custom home builder, was in different areas of construction. And I kind of looked around and I'm like, man, I'm helping all these investors buy all these short sales and foreclosures, and I'm helping them buy it and I'm helping them sell it. Okay. And I'm pretty much determining valuation and doing all the work for them as a broker. So I went to my dad and said, look, I don't know what the heck I'm doing when it comes to construction. That's your forte. Would you consider partnering with me? I'm going to go buy up these houses and I'll handle the acquisitions and the dispositions and capital if you'll just do the construction aspect. And we did. And I ended up shutting down the real estate brokerage and focused solely on investments till about 2012, 2013. I was looking at apartments. The market was slowing down. There wasn't all that distress out there. And we actually had to go and market for deals. And so, we started looking for apartments, struggled to find apartments back then. Who'd have thought? I mean, that was like crazy deal. Everything I looked at back then would have been an absolute home run today, but I was being conservative and ended up finding a mobile home park, bought that mobile home park, and the rest is history. But I think what I learned from 2008 till my first park acquisition was I don't want to be in a trading business. I want to be in a business that pays me on a reoccurring basis to own it. I want to have a lot of cash flow, not just a little bit. So buying single family homes, that was kind of off the list. And on top of that, I wanted to be able to control the value, which I couldn't do on single families, but I could do with commercial properties like mobile home parks. If I force the income up, I can then force the value up, which is very cool to me. It was something that I was not aware of flipping houses all those years.
Yeah. Nice. Very cool. So how many pads was that first park that you purchased, and when was that?
50. Yeah, it was 57. And what was the follow-up question?
What year was that? Do you remember?
We bought the note, and this is a little bit fuzzy because we ended up buying the note on a non-performing loan
Okay.
on a mobile home park in, I want to say it was late 2013. Could have been, I want to say late 2013. We foreclosed on it. This is the hairy part, the gray area. We foreclosed on it in 2014, which would have put me, in an ownership position of a mobile home park. We bought this deal off of a bank. We'd been buying non-performing loans from
Nice.
banks and funds on residential. And so I was able to acquire the loan on that. It was already in foreclosure. We knew that was the game. We were going to take it back, and we did. And so in 2014, it was 57 pads. It happened to be in my backyard, which is really cool.
That's cool. Yeah.
Probably what got me over the hump on a new asset class. I wasn't familiar. I was looking for apartments. And when this came across my desk, I had to learn it quickly. I had to study up very, very quickly because I hadn't been researching it at all. But because it was in my backyard, I knew the location was solid. The land value was even more than what I was paying for the park, and buying the debt made it a real steal. A very hairy deal, but very good basis.
Non-performing note. I could guess that there's obviously a lot of work that was going to have to go into this park. Tell us a little bit about like what you had to do to get it performing, and what that looked like.
So what we did, long story short, a buddy of mine was a commercial banker. He calls me up and says, "Hey, this other commercial banker I know has got this loan. It's on a mobile home park. I know you're not looking at that, but would you consider it? It's close to an apartment, similar to apartment." So I looked at it, and it was interesting because whenever we had bought non-performing loans before, the performance was pretty hairy. Like or I guess you could say fuzzy. You really didn't know what you were buying. What was interesting about this deal is the bank had already put it into receivership. So we had a receiver giving us, extremely clean financials on a distressed asset, and they're court certified financials, which is sweet. So even though we couldn't talk to the owner and we couldn't talk to the manager, the borrower, or I'm sorry, the tenants or anything like that, we had very clean financials that we were looking at. And the property wasn't doing too bad, believe it or not. From an income standpoint, the receiver was eating up every dollar he could of the cash flow. So it was showing negative to the bank, but he's eating up like $8,000-9,000 a month in receivership fees on this thing. And yeah, I mean, it was just amazing. I learned a lot about receivership on that deal too. But what was cool about it was the reason he was in default was because of his debt. He had bought this park as a developer. He was going to develop it into something else, paid like $4 million something for this parcel. It was in a prime location, don't get me wrong, but it wasn't worth $4 million. But in the last peak of the market, he thought it was. He was going to redevelop it into something else. And then when the market tanked, he wasn't set up to run a mobile home park for that many years. And so it was negative because he had a $4 million loan on a 57 space park with, call it $350 lot rent. I don't remember exactly what the lot rent was, but you could just do that in your head and go, okay, he's super negative. And he defaulted. But anyways, we took it. We bought the loan. And if you want me to get really in the details on this, I know we got a lot of park people on here, so this might be interesting. Everybody was trying to buy it through the front door. They were trying to buy it as a short sale. Okay. The problem was there was over $1 million worth of code enforcement liens on this property, which is, very difficult to get around. And so by us going to the bank, tying it up on a contract to buy the loan, the note, We then had some due diligence time to go to the county. We got a consultant who was basically a really well-known general contractor in the area and had done consulting work for the county. So he kind of brought us to the table and negotiated out some terms with the county where they said, hey, look, if you're going to clean this up, we won't go after you anymore. And we're, as long as you do these things, we won't chase you and try and lean you up again, because our foreclosure was going to wipe out their lien. So we knew that we could clear off the lien, but they could just start over again and make our life hell, So
Yeah.
we came to written terms with them in our due diligence period. And then when we foreclosed, we bought the loan, we foreclosed out the owner and the liens.
Was
And
this
then
right?
Huh?
Did you right away foreclose on the note? Like as
Yeah,
soon as
because
it
they had
over?
already started. They had already started the foreclosure process, which is why they were in receivership. And
Yep.
so yeah, we just took their foreclosure and stepped in as party plaintiff and took it over. And then we went to the borrower. We said, hey, look, you owe us $4 million. Like we took a pretty big haircut on this, and a paper haircut, not a real haircut.
Yeah.
Of course, we bought it at a significantly lower price and said, look, why don't we work something out? We'll take you off the personal guarantees, because he had personally guaranteed all this debt. Great lesson. Pay attention to what you're personally signing for, because when things go the way, a different way than you plan, you could be in this position. And he ended up writing us multiple checks. I mean, it came out to like $125,000, $135,000 over 6 months or so to get off that personal guarantee. And he performed, and he was a good guy. He didn't do anything wrong. He made bad business decisions and the market changed.
Yep.
But he was a good guy, and he was trying to work it out. He didn't want to have he didn't want to have anything on his credit, and he didn't want to have us go after him. And we were amicable about it. So we reduced our basis even more by 135 grand more, and then used a lot of that cash and the cash flow from the property to make improvements. There was only a few vacant lots. We brought in some homes, made physical improvements, redid the roads, built out some common area parking. We did landscaping. I mean, just all the things that we all know we do on these properties. Brought in some homes and stabilized it in a little over, it was like 18 months, maybe a little bit less than that. We refinanced, recouped all of the initial investment, put on some really nice long-term non-recourse debt with a life insurance company, smooth sailed it for quite a while until we sold it at the end of 2019 for literally 10 times what we paid for it. So we paid about ultimately at the end of the day, we paid for that deal. Our basis was about 625 or 650,000, something like that, on a $4.2 million loan.
Jeez.
Yeah. It was never worth 4.2, but that's what he borrowed. Yeah, we ended up selling it for $6.5 million. So
nice.
It was a home run. I wish every deal was like that. But one thing that was pretty cool about that was that we were familiar with buying debt. We were familiar with workouts and foreclosing. I mean, it wasn't our first rodeo in that world. Yeah. I could have never bought that had I not done it before. And it just so happened that our skill set went really well with that deal. And that's what sparked off the whole mobile home park investment. I never bought a mobile home park note after that, but it opened up the door and made me the perfect buyer for that deal, because most people couldn't buy it because they're trying to go in the front door. So nice. It was a home run, but it really made me realize the opportunity in the mobile home park space, because back then, think about this. Think 2014 mobile home parks. I don't know when you guys got in it, but it was trailer parks. Nobody wanted to touch them. There was no institutional investors really going after them. I shouldn't say that. There were very few, and it was the ugly redheaded stepchild of real estate at the time. So it was like, whoa, what did I just stumble across? There was no podcast about it. So yeah, it was pretty cool. It was an awesome deal.
I mean, what an amazing first deal to get into. I mean, like you said, you did have experience prior because, purchasing non-performing notes is a different beast. And there's a lot of things that you do need to be aware about, but but it kind of brought up something like I used to work for a hedge fund and we used to buy non-performing notes all the time.
Yeah.
And even right now, as we're going through our acquisitions, it's like, I didn't really think about like we should actually be reaching out to commercial bankers that we know for these non-performing notes. I mean, you're not
For
going to
sure.
come across too many of them, but it's still an avenue that most people probably are not touching.
Well, it's a world that comes and goes with market cycles, right? So,
Yeah. Yeah.
I don't know what company you worked with, but a lot of the funds that were buying up bad debt
Yeah.
for a while there in the downturn, they basically go out of business every market cycle because the market gets good. There's no
Yep.
distress. So there's nothing to buy. And everybody kind of goes into other things like you did, where that market is coming back. I'm starting to see non-performing loans cross my desk, or I'm like, not necessarily on mobile home parks, but apartments. I'm seeing resi loans coming across my desk. I'm seeing some pretty unique opportunities, hotels, clearly retail, especially malls and things like that. But for a long time, from probably 2015 until this year, I hadn't seen a single non-performing loan come to market. It's just a dead market, and it's coming back. So I'm really pumped about 2024. I'm thinking that we're going to have some pretty cool opportunities to acquire some of that stuff again. And guys like us are the few and far between that actually know what to do to be able to take advantage of those strategies. It's a very advanced, complex strategy, risky strategy, but profitable.
Yeah, exactly. I mean, you definitely got to know what you're doing. It's not something you want to just jump right into. And it's also, it's more of who's on your team, like the attorneys, the specialists on that side that can process all this paperwork for you and make sure you're doing it correctly. And then, understanding your laws in that particular state too. So it's
a heavy legal business, legal business. I mean, big time attorney stuff, servicers, like you said, each state has different laws depending on if it's residential or commercial. Yeah, totally agree. But I'm looking forward to making money in that world again.
Yeah, I do. Yeah, I agree. Like it's very cyclical, but it's coming back. And we've already heard the news, I think it's like trillions. Is it trillions of commercial debt that's coming due? And, I don't know how how they're going to exit out of those.
Did you happen to see on my Instagram, I posted a picture, it was a graph, and it was actually a chart, not a graph, but basically it shows in October of 2023, what happened with the first tranche of loans resetting in the commercial real estate world, non-owner occupied commercial commercial loans. Yeah, go ahead and check it out. But it's pretty wild. It was some market data that I got from a data aggregator, and it's accurate. It's not like anybody pushing hype, but when I saw that, I went, oh, I got to do a screenshot of that, because it's just a hockey stick up with all the loans that are coming due, all starting in October. I think there's a nickname for it. Somebody was calling it Red October or something like that. So yeah, it's going to be very, very interesting. And that's facts. That's a fact. It's not like, I know in past in past years, I should say, a lot of people are always like doom and gloom. Oh, the market's going to get bad. It's going to tank. This is probably the year. No, I'm not saying that the market is going to tank, but there's clear factual data that anybody can look up that proves that all of those loans are resetting. And if you do the math, unless all of those lenders do workouts, it's going to be a heyday. Takes time, but
it will be interesting, just because the same thing as you're back in 2008 in the crash, right? We were around doing business at that time. So there was, a big surge on short sales. There was workouts there. Even now, COVID, there was forbearances and stuff like that. It will be interesting if these commercial lenders will do a workout, because that if they all default, that's a massive amount of people and units and commercial buildings, apartment buildings, where banks are not suited to take these over.
Yeah.
We're working with a hedge fund, we bought big multifamily back then too. And these banks would come to us to purchase them. And they just cannot handle taking over that many. So it will be very interesting if they do start putting some workouts or like some kind of bailout, because that would be a massive hit to the market.
Yeah, people would be wiped out. So, it's a 2008 situation at least. The other thing
Mhm.
is too with that is, and I know we're going super dark and doom and gloom, but for me, I think it's opportunity. Like I'm pumped
Yeah,
for my
man. Yep.
market, dude. But
Yeah.
the interesting thing about that too is, you're probably going to see banks, and for the most part, especially the smaller banks, regional banks even, and life companies, those guys will probably do workouts. They'll just
Mhm.
extend, right? But it's the securitized debt that has very little wiggle room, and they've
Mhm.
got special servicers that'll step in, and it's cut and dry. It's like, if you don't do this, if you don't pay, this is what happens. If you don't pay us off, this is what happens. So it's that kind of debt that is very hard to see how that gets resolved. But
Yeah.
anything's possible. You're dealing with people, so who knows? It could get worked out.
Are you going to look at other asset classes, and how are you going to prepare for this
Yeah.
tsunami that's coming? And maybe our listeners can prepare in a way and get situated.
Yeah. So I love mobile home parks because they are such a great asset class, especially in recessions. What we're probably going to see, and none of this is a prediction. I'm not an economist. Okay. So I'm not saying on this date, all these foreclosures are going to hit, but I'm just kind of reading what's obviously going on. Right. Because mobile home parks didn't go through the crazy debt that
Mhm.
you saw apartments, that you saw, even retail and some other asset classes go through. I'm not so concerned. There were people in the last maybe 2 years who are kind of just getting into the business, especially guys coming over from the apartment world, that were getting pretty
Yep.
aggressive short-term debt. But you look at apartments, I mean, you couldn't buy an apartment building that made financial sense for the last 3 or 4 years without short-term floating rate bridge
Yeah.
debt, basically bridge debt, that a lot of those people didn't put caps on the floating rates and things like that. And I've got some friends in the apartment space, and they're doing capital calls. They're just getting creamed, and I feel for them because it's not something I would want to be going through by any means. At the same time, I think apartments will be the biggest opportunity in this whole market cycle and what happens with these loans, because
Yeah.
you just couldn't buy anything without floating debt.
Yeah.
So
I actually we
interest
just
only
looked.
for like 10 years. Go ahead.
Yeah.
What were you going to say?
I just say we just looked at an RV park in Texas where they had an adjustable, and it was at 7.5 right now.
Yeah. Yeah. I mean,
Just bring it.
especially development.
Yep.
If you're developing an RV park or you're developing pretty much anything, some of those loans, if you missed the timing on it, you
Yeah.
could be in a construction loan that's coming due because it was only a short-term loan. This is what's different. I don't think we see a lot of, horrible underperforming assets. I think we see some good assets with good borrowers that have bad debt losing those properties, which is sweet for buyers who have the liquidity and the know-how to buy this stuff. And we're going to be able to buy some pretty cool properties purely because of the bad debt and the situation that the
Yep.
borrower got themselves into. And that's it.
Nice. I think I'm going to label the show the upcoming
Doom
opportunity.
and gloom.
Yeah.
Yeah. I'm actually doing an event December 16th, and it's all about taking advantage of the commercial real estate
Nice.
financial crisis and taking advantage of that this next year. I got some awesome speakers speaking at that. It's a virtual event, but
Cool.
it's something that this isn't the first time I've talked about it, but I think it's one of the first times I've talked about it on a show. So thanks for bringing it up and let me go deep on it.
Nice. When is that event happening?
December 16th.
December
And
16th.
yeah, got some really awesome speakers for that. Like very well-known commercial real estate investors that have been through other market cycles. If you guys know Dave Seymour, he was he was the star of what is it, A&E's Flipping Boston TV show. He's now in commercial real estate. I've got Chris Rude speaking on that,
Okay.
and also Joe Evangelisti, which Joe is in self-storage.
Okay.
Chris is in mobile home parks.
Yep.
And like I said, Dave is big in apartments and development. So it's going to be a pretty awesome event.
Nice. And
But
how
that's the whole topic.
how does somebody go to sign up for that event?
Great question. I'll get you the link.
Cool.
I don't know yet. We're just about to start marketing the event now.
Okay, cool. Yeah, and we'll include your information on here too at the end and everything. So
cool. And it's property agnostic. So it's not mobile home parks. It's all property, all commercial property types. So it's good for everybody. Yeah.
Very cool. That's awesome.
It makes your first deal even more impressive because you always hear how mobile home parks, it's probably the least asset to default on a loan. So the fact that your first deal is a defaulting mobile home in your backyard, it's the stars.
Too good to be true.
Crazy.
Too good to be true.
Too good to be true. Really.
Yeah. And now that you kind of mentioned that, there's probably going to be more like that. I'm thinking right now in real time I'm going to write this down, a marketing strategy to target more deals similar to that. Because if you think about that deal, I'll talk to you about it offline, but then you could take advantage of it too. But I just thought of a strategy where I could pinpoint some similar deals to that. But yeah, it was a unicorn deal for sure.
Yeah, nice. So I'll say mobile home parks, you're at what, 1,000 pads right now?
Yeah, a little over 1,000. I think probably about 1,100 right now.
Nice. And what markets are you focused on with your mobile home parks?
So I look everywhere other than the communist states. So I'm not looking in California, Illinois, New York, New Jersey.
The red states, basically.
Yeah.
Yep.
And so I'm looking everywhere, but we currently own in 5 states: Florida, Georgia, Minnesota, Pennsylvania, and Texas.
Okay. Nice.
Looking everywhere.
How's Florida been lately with all their tax issues? I know there's multiple states going through right now, but Florida has been hit pretty hard, especially on the single family side. But what's it like with the mobile home parks that you have? Are they being adjusted? These insurance companies leaving you, or are they adjusting the rates? What's that looking like right now?
So there's a kind of a combination of issues. You've got property taxes, which were mentioned.
Oh, that's true. Yep.
Texas is getting creamed on that. Insurance is probably the bigger challenge that we're going through, just with all the hurricanes and things like that. We've had, we're getting dropped randomly, like we've had multiple renewals where they just go, yep, we're dropping you. We're just not going to, either we're leaving the state, we're not covering Florida anymore, or we're not going to cover this asset. We had one just recently, our nicest community, great location. I mean, it's super clean. It's 55 plus, just a really nice amenity community. And the insurance company decided they would not do wind coverage on the property all of a sudden on the office and the manager's house. And we have a small motel at the front of that as well, purely because the plumbing inside the buildings are cast iron or something. And I went, how does wind coverage
affect
anything to do with that? And so we had to go and get quotes to see what it would cost to replumb it. And it's a mess. I mean, it really is. And I don't typically expect government to solve any problems, but I don't know how it gets solved without government intervention on this big problem. Because
and Florida is getting involved, right? Their government is getting involved in that. I'd be curious to see what they work out. It's happening in multiple states. It's happening in California. It's happened in Jersey.
With the fires.
Yep.
In California.
Florida is a big one. There's multiple states right now that are having issues with insurance and getting property insurance.
True. Yeah. Florida is definitely the one that we've experienced it in, but you're right. It's happening in other states. So I don't know what'll solve it, but we're just fighting the good fight. It's kind of like people have said, well, are you going to keep investing in Florida? Are you going to keep doing things there? I'm like, everything else is phenomenal here. Like
Yeah.
Florida's awesome. Okay. We love it here. Doesn't mean I want everybody to come, but we do love it here. And I happen to live here as well. But
Okay.
it's a phenomenal state to do business. It's a phenomenal state to
Mhm.
live in. It's the best, at least from my point of view.
Yeah.
So for the one headache that we've got to deal with, as long as we can continue to navigate it, we're going to continue to invest here.
Nice.
Yep.
Is that where you own the majority of your pads is in Florida or what
Highest
state?
concentration in Florida.
Okay.
Yes.
And are
Yep.
you like Central Florida, South Florida? What's
All over.
all
Yeah,
over?
coastal, central. I've got a partner that I've been buying some stuff with recently that's more central and north central Florida. Don't
Okay.
own anything in the panhandle right now. But I have owned in the panhandle before. Yeah, kind of all around the coast and in the center as well. And it's a great state.
Nice.
It's a hard state to buy parks in though.
Yeah.
So, a lot of people will say, I'm looking everywhere, but I don't look in Florida because it's so expensive. It's a hard state. I think being here, physically being here, has been, I was kind of thinking about that. I'm like, man, everybody always says there's no deals in Florida, but I just keep buying them. And it's probably because we're physically here. So we have an upper hand against, from other people
Yeah.
coming in from outside. And not because we're anything special, but we're just here. So it probably helps.
Nice.
We've even been a little bit apprehensive with
Sure.
Florida just because of all the stuff we name. So we can see how there's probably a little bit more opportunity for you who has a good comfort zone.
Yeah.
Yeah, and there's some unique laws here too. There's prospectus. There's what's called a prospectus, which is basically a document, kind of like what you would expect for a homeowners association. It's a big disclosure document, and there are some quirky laws in Florida that aren't as sexy for landlords, for mobile home parks specifically, because they're trying to protect the elderly people that,
Mhm.
historically have occupied a lot of the mobile home parks. So if you know how to navigate it, it's cool.
Yeah.
If I'm coming from out of state, it's something I'd have to learn.
Yep. Yeah, that's why, we talk to people, even for purchasing single family. It's like pick a few markets and study those markets, know those markets, connect with attorneys that are in those markets, real estate attorneys, because every state, even counties have different nuances of where you're doing business. And so if you don't know that, you can get into big trouble not operating the correct way.
For sure. Yeah. I mean, I've seen some people buy parks in Florida and don't know what a prospectus is.
Mm-hmm.
And they bought a park that has a prospectus, but it needs to be updated. And there's some regulatory things you've got to be fully aware of, even for like rent increase periods. Like every state has their own landlord tenant laws, but some states have specific laws for mobile home parks. Some don't. Like Georgia, there's not any special laws for mobile home parks. It's general landlord tenant laws that you have to follow, which makes it easy. Some of it doesn't really work well with mobile home parks, but I'd rather have that than, very specific laws for parks like we have in Florida. But just get good attorneys.
Can we rewind to your second deal after that first one, which was stars aligning, Hail Mary, Hail Mary, grand slam home run? What was the next step? How did you do the marketing for your next deal? What was it? How did it come to play? Can you kind of walk us through that second one?
Yeah, and it's interesting because right around that time, I ended up buying my first self-storage facility. It wasn't like I owned parks for a long time and then got into storage. I wouldn't recommend somebody do this. I'm a one-trick pony. I'm not great at a bunch of different things. I even have a hard time taking off my storage hat and putting on my park hat when I'm looking at financials. And I have to kind of like think, wait a minute, different business, different asset class, this functions differently. So I wouldn't recommend anybody does that. But within probably 6 months, I bought a self-storage facility locally to a big one, a 55,000 square foot facility in my backyard there too. And that came from letters. I was sending out mailers, and got a hold of the owner. That was a crazy deal. It seems like every deal, especially in the early days, was just wild and crazy, for a lot of hair on them. But, when you're new and you're focused and aggressive, you kind of look at some of those hairier deals and say, I'll fight the fight and get it done, and I'm glad I did because they were profitable. But that came from a mailer. The next deal came from actually a management company. I'm trying to think of how that worked. I was doing cold calls, contacted this community owner. He referred me to a management company. I'm like, why are you sending me to a property management company? And it just so happened that they were brokers as well. And he goes, yeah, the park's not doing really well. I'd sell it. Call my management company. So I call them, and they own a bunch of property. I won't ever mention the name of the company. They're a reputable company, but they just were slumlording this property. They were just horribly managing it. And I think what it was is they manage a lot of very high quality communities around Florida. And what the management company told me was they were doing a favor for the owner. They manage other stuff for him, and he wanted them to manage this. And in the back of my head, I'm thinking, you're really not doing them a favor, because high collection balances, property looked horrible. They were going through a transition where they were developing a piece of, a section of the parcel. They had cut it off, and they were, doing a deal with a major chain gas station. And so there's just all this stuff going on. But the way that they were managing the park side of it was just horrendous. And we ended up buying that park. And I don't want to say there was a lot of creativity in that, because we cashed them out. Interesting story, though, on that. I met the lender that I used for all of my institutional financing now.
Nice.
Because I was going to all these different banks. I'm going to these commercial brokers. And, when you say that you own one other mobile home park and you're buying this really sketchy park, they weren't taking me too seriously. And the broker that I was working with dropped me kind of late in the game. And my current broker stepped in, and I met him, and he took a swing for it and really fought hard to get that deal done for me. I've just been loyal to him ever since, because he took a chance. He spent a lot of time with me when he was doing way bigger deals. I was a little guy, they do a lot large portfolio transactions and all that. And so for him doing a financing deal on $1 million loan or $800,000 loan, and with as much hair as I had and the property had, it was a cool deal. But that being said, we bought it. It had a ton of uncollected balances. And the first thing that we did to all those tenants is we said, look, you owe us all this money.
Yeah.
Okay. But let's work it out. And so we started going to these tenants, and we discounted some of it. We let them pay it off in a couple of payments in some cases. There were a few people that just needed to go. But I think out of 79 lots, 76 of the lots were occupied or something like that. Take that back. All were occupied because they were actually demoing a bunch of homes in another section of the property that they were getting ready for this gas station. And we said, whoa, whoa, whoa. We see, 3 homes that were really rough, but all we had to do was move it from one section of the property to the other. And we negotiated that the seller would move those homes to the part of the parcel that we were buying onto those lots, and we would get them set up. And so anyways, it was full, and we went to these people and just said, hey, work it out. Out of 79 lots, probably 76 or 77 of them had people in the homes. I think we only evicted maybe 1 or 2. I mean, that's pretty good. And out of the 79, I want to say we had like 20 something people not paying. They were serious balances.
Yeah, geez. Yeah.
And so that's what I said. They weren't really doing the owner a favor by managing it for them, because they weren't collecting. And made a bunch of improvements to the property, and it's a great property. Now it's probably, we refinanced that in about 1.5 to 2 years. I don't remember exactly when, but we refinanced that in 1.5 to 2 years, and didn't add any balance to, we just recapitalized the deal, got our cash back. And after that, we've been humming along really good cash flow wise. I think our balance on that is like, $1,100,000 or something. And that thing's worth probably 4.5.
Nice. Yeah.
Yeah,
All,
four and a
all
half, I
tenant-owned
think.
homes?
What?
Are they tenant-owned homes?
All
And then
tenant owned.
is your whole portfolio primarily tenant-owned homes, or do you deal
Yeah.
with owned?
We don't do any rentals at all. We have, shouldn't say it, we have probably 5, 6 rentals in our entire
Out of the 1,000.
portfolio.
Wow.
I mean,
Nice.
it's very, very little. And you know, for the mobile home park investors out there, might say, well, that's awesome. You know, it does have its problems. Our occupancy, like when we want to turn a home, we get a home back for whatever reason, it takes us longer, right? Or to
Mhm.
infill lots when we bring in homes, we're not leasing any of those. We're only selling them. So, you know, there are some groups out there that will infill at very rapid paces and they'll bring in 20 homes at a time in a single community, lease them up, and then go back and start selling those
So,
homes off, you know, because they want to get occupancy fast. Where for us, we may have some homes be vacant when we're, you know, bringing them in for longer because we're just not willing to rent them. So there's some positives and negatives, but it's worked well for us. And, you know, anytime we kind of look at other portfolios and we look at ours, we go, we're in pretty good shape. We have very little turnover, very, very good from an operational standpoint, in the sense that we don't have all this turnover and everything. And we don't have to deal with a lot of home renos and things like that. So
nice.
we're in a good position.
What would you say helped with the success of having that many delinquent residents start paying, and how, and what kind of different unique things did you put in place to have them start paying you?
I mean, we got firm with them. Number one, we gave them a 30-day window to get caught up. But keep in mind, a lot of those people had balances of $2,000, $3,000. I mean, just very high balances, and they hadn't paid in a long time. And so when we said, hey, look, you've got 30 days, you need to be on track on the 1st of next month, but these back balances, all right, we'll work those out with you. We'll take 1,000 or 2,000, or we'll take the $3,000 that you owe and split it up over 2 to 3 months. That's all free money for us, right?
Yeah.
So that's like a huge bonus. If we've got, I'm just making up numbers, but if you've got $30,000 or $20,000 in outstanding balances, and this kind of comes into that whole, you know, workout mode of being a note holder, that's kind of the way we look at it, is we go and we say, hey, you owe us now. Let's work it out. We'll take a discount on it.
Yep.
It's all extra cash in our pocket that we didn't even have to, you know, deal with before. So that's what we did. And we just got very, very strict. You know, we said, hey, 1st of the month, if you don't pay, you're
Mhm.
gone. We will evict you. And of course, some of them test you, and then you have to go through that process. And then everybody realizes very quickly, new sheriff in town, new systems.
Yeah.
We back then we didn't have electronic payments, but we gave them very clear instructions on what they had to do. And we just evicted people who didn't, you know, and thankfully we didn't have to evict a lot of people, and we got a ton of cash for doing it. Think about it. That management company could have put all of that cash in that owner's pocket
Yep.
in the time that they owned it. And on top of that, the owner probably wouldn't have wanted to sell to us had they been making good money on it. But
Yeah.
again, it was just horribly managed. So
Yeah, and that's usually the ones that are being traded at that deal. It's the management behind it, right? It's either mom and pops that are trying to manage it themselves, not really having a clue, understanding this is a business, not just a real estate deal, and then, or you have bad property managers that are not doing a great job on that. So
for sure, undercapitalized. You know,
Yep.
they went in thinking that they could just use the cash flow of the property to make the physical improvements, and things start going backwards. They estimate the complexities of getting homes back, titles, renovating, selling. This business isn't easy. I mean, it
Mhm.
really isn't. In concept, we just rent dirt, right? But it's a hybrid model between a rental and a sales model combined. And that's actually more complex and complicated than a lot of property types out there.
Yep. I have this discussion with a couple other underwriters and whatnot, but I mobile home parks and RV parks, whatnot, are probably one of the more complicated assets to underwrite because of the different variables that are associated to these parks, right? And
For
it's
sure.
I have this discussion all the time because it's like, oh man, what do I do here? This is unique. How does this really increase the value? And so I'm glad you do bring that up. It's, a lot of people do think that getting into the MHP space is, oh yeah, I'm just renting out the dirt. There's a lot more to it than that.
Way more capital intense too than people realize. I mean, infilling lots, a lot of newer investors in the space see, a 50 space park with 10 homes sitting on lots and like, oh man, I could steal this for like 150K or 200K. This is such a great deal. I'm like, yeah, dude, you got million plus going into that thing. I hope you've got the cash. I hope you've got the ability to infill that thing. Otherwise, you're going to find yourself a couple of years from now sitting on a park with still low occupancy, a loan coming due. The new lender won't refinance because the occupancy is low. And it's just things that we don't, as new investors, realize it just seems cheap. So we want to buy it. I'm like, I'm not buying a park 50% vacant. I'm not an infill expert. So I can
don't
do
purchase
it.
at these pro forma numbers, right?
Right. Yeah. It's like, okay, oh, by the way, they performed to fill up that park in a year and a half and they got to fill 40 lots and they've never done it before. It's like, that's just set up for failure. But again, there's one more silver lining, right? Some of the investors who got into the space didn't educate themselves, didn't do their research, didn't work with people who are experienced. They came from other worlds. They bought deals they didn't understand. And not only are there debt issues, but some of those investors are realizing that it's not what they thought it was, and they weren't able to perform. Investors are pissed because they didn't hit their pro forma if they had investor capital, and they're in trouble, and they're going to need to sell purely because they didn't know what they were getting into, and they're burnt out because it's like, oh crap, we couldn't fill all these. We performed it out. We were going to buy used homes for $5,000 a pop and fill up 40 lots. It's like, okay, man, that's so unpredictable. So yeah, I think there's two silver linings, two opportunities. It's the debt and the unsophisticated investor who jumped in without knowing what they were doing. I bought a couple of parks from guys who got into the park space thinking it was going to be, rainbows and unicorns, and realized real quick, it ain't what they thought.
Nice. How many pads are you kind of targeting for your portfolio for each park, or does it really matter?
Are you saying like when I buy a park, what's kind of the minimum size, or
what's the minimum? What's the average that you are purchasing?
Average community size is around 80 lots that we have now, kind of in that sweet spot.
Yeah, I was going to say, yep.
But I'd like to go larger. I think it's just a matter of finding deals that make sense. And we can go kind of deep on another subject, and that's funds versus syndication versus other strategies. We've syndicated every deal. I mean, most of the investors are the same in all of my deals. I don't typically raise 50K at a time or anything like that, but I've got some larger investors that have invested with me over the years, and not doing a fund model, I think, was a good move. I probably didn't grow as fast as some others, but I recognize that having that fund structure really requires the sponsor, the fund manager, to deploy capital very quickly. And to do that, you sometimes buy things at higher prices, or maybe what you wouldn't prefer to buy. And just being able to independently sponsor each deal has allowed us to pick out properties that we really want to own for a long time. And we're not doing, we're not on a business model where we have to sell in 3, 5, or 7 years like a lot of the funds out there. So it's worked well for us. Will I do a fund in the future? Maybe. But I think what we're doing right now is working really, really well. And it allows us just to pick the deals that we want to buy and own for a long time. So it's, if we can find some larger parks, I'll buy them. But I'm not in a rush to deploy capital. So it's a good position to be in right now.
And I feel like that space, or that many pads, that's criteria, is a pretty good spot to be in, because you're not competing with the funds too much on those. You still have some mom and pops, or not as sophisticated investors, or investors I jumped into not really knowing what they're doing, being able to sell. So I think that's a pretty good spot. And of course, like the minimum, that what's your thought? I mean, ours is 40 plus pads.
Yeah, my answer to that is usually 50 or more occupied lots. But I own some stuff that's in the 30s, just
Yeah.
purely because it was a great location,
Mhm.
great opportunity, or it's close to something else that we own, deals like that. But generally speaking, 50 or more occupied lots if I'm going into a new market is kind of what I want. And of course, if the rents are high, then I'll go a little bit smaller. But the larger the better. Like I if I could buy 300 space parks all day, every day, I'd do it. And I got the capacity to do it, but I just haven't had a lot of
The
great
right one.
deals
Yeah.
in
Yep.
that size. Yeah.
Are you
Nice.
looking at park-owned home communities? And have you bought park-owned home communities and converted them to tenant-owned? Or are they
Yeah.
just automatic? Can you
Yeah.
tell us?
Great question. So we have bought communities that were 100% park owned and we've converted them to lot rent.
Oh,
Like I
nice.
mentioned, the whole portfolio is all lot rent. But we have never bought a park and kept it park owned as a rental model. We'll still do the pro forma based on selling off all the homes. What's lot rent going to be? We'll figure in a little bit towards the homes, depending on the condition of them and what we think we can net on them. But I am not very keen on rental communities, clearly. I mean,
Yeah.
you can look at mine. But what I would say is we are working with some investors now that have bought park-owned home communities, ran them as rentals, got burnt out on the whole rental model, and we're selling off the homes in their communities for them. My dealership is. So we're not just selling in our own communities now, we're selling in other investors' communities just because we're set up to sell it pretty good
Yep.
volume and we got the marketing down, we got the systems down on that. And so yeah, we just signed a contract recently for another 50 homes to sell in another
Nice.
community owner's portfolio. So pretty cool. I think it's a great extension of our business and
Mhm.
it's working well for us now. So we're going to continue to look for other communities that either probably wouldn't be excited about selling 2 or 3 homes in a community. But if somebody's got 10, 15, 20 homes or more in their community, we'd potentially go and sell for them. And that way they don't have to deal with it. It's pretty cool.
Nice. So you brought up a good point. When you purchased that park that was tenant owned, I'm sorry, park owned homes, you bought it on a valuation of it being tenant owned. And so you worked out
Yes.
the deal with the seller based on those numbers, and
Yes.
everything else was kind of a bonus, which that's great. I mean, that's ideally how you should be purchasing, right? And
For
then
sure.
the other thing you brought up basically is just some of, and I know you have some vertical integration. You talked about being a dealer, right, and being able to sell other lots, but you also have a property management company. Tell us a little bit about your different businesses that you have within the mobile home park and storage space.
Yeah. Yeah. So we don't manage any of our self-storage. We use third party or I've
Okay.
got an operating partner that manages them. So not doing any self-storage management, just the asset management of them. And then on the mobile home parks, I mean, we've got the management company, we've got the dealership, and I've got an education company that teaches people how to invest in mobile home parks. And
Nice.
I've got a brokerage that acts as my acquisition team, but we also broker parks that we pass on that are off market. And so we do
Cool.
that as well.
Yep.
We're not a traditional listing brokerage where we're going to go put up a sign and do listing agreements and package it up and all that. It kind of functions like a wholesaling business, to be honest, where we're looking at all the markets that we want to buy in. And if it's a deal that doesn't fit for us, we broker it to, our database of buyers, like, other guys buying stuff off
Mhm.
market. And so, yeah, it's a pretty cool little ecosystem going. What's neat is when the dealership or the brokerage refers to the dealership or vice versa, or to the education company. And it's cool to see the businesses kind of working together. And it's worked well for us. Like I said before, I'm really not that talented when it comes to, being involved in a lot of different businesses or different industries, I should say. So it's worked for me. is staying within the same industry and just branching off. And, like the business that we have for our dealership business, we have it set up for ourselves. Once we've got it figured out for ourselves, we look and go, okay, who else can we help utilizing our expertise in this area? And I've got a great guy that runs that business for me. And
Nice.
it's working well. So now I can go and help other community owners who maybe don't want to build that out. They've got 1 or 2 parks, and it's like, am I really going to go get a dealer's license? Am I really going to go order homes and deal with all that, or, even sell homes in my community? And there's a lot to it. There's, getting set up with lenders and all of that stuff. It's pretty complex. And if we can go into a community and set up the lenders that we know are good, we know their underwriting, we know all of that, we got the relationships, set up the lenders for the retail buyers, we can do all the marketing, plug and play, and we've got the license already. It's a good way to generate additional revenue for that entity and have it not just be a, supporting entity for our portfolio.
So you have like key personnel that is running the different segments. So that kind of leads into like what I was thinking too, is what's your teams look like and what are you doing within your business now? What's your involvement?
Yeah. So there's 2 answers to that: what I'm doing and what I want to be doing. So I've got someone to run each business, we'll call it the management company, the dealership, the brokerage, and the investment company, and the education company. I shouldn't say that. The education, or the investment company, I'm pretty much running that. I've got some good people in that business that I don't really have to do a whole lot of the day-to-day in that. Like the asset management side, I've got a full-time asset manager who's saved me multiple times, and she's a rock star. But accounting, all that stuff is in that business as well. But for each of the other businesses, I've got someone who's running it, and I'm still involved maybe more than I want to be, but I'm not doing the day-to-day of any of them really. I'm more day-to-day in the investment company than anything, and education too. I mean, I obviously content for education and the coaching calls and things like that. That will probably never change, but honestly, that's the fun business for me. I really enjoy that part more than any of the other businesses. That and the investment company are my favorite. So
very cool. Awesome.
We operate on EOS. If you're familiar, actually Rise. I don't know if you guys are familiar with that. Yep. It's a break off from EOS. So it gives us good structure, good systems. Been doing that for probably been at least on EOS or a variant of it for 4 years at least, which has been very helpful for us.
Nice.
What is EOS?
Entrepreneurial Operating System. And Rise, which is the platform that we operate on, it's a variant of EOS, is basically a business system for businesses. I mean, it's kind of like taking your large corporate structure, your meeting structure, your KPIs, all of that stuff, and it shrinks it down for the small company, for the entrepreneur who's got a smaller business. And it's pretty awesome. I mean, our business was in shambles. Like we were, what I called us was firefighters. We were firefighters, and we just created so many problems by not having any systems. It's just me as an entrepreneur out buying properties, and think about it. You're just out there. You don't know what you're doing. You're not. Sure, I have business experience before that, but I'm not an operations person at all. I'm definitely CEO, visionary type personality, not COO and, integrator type operations person. It's just not me. So I'm out running around buying all these assets, accumulating along with the problems, and then not being systematic on how we're doing things. And it kind of got to the point where I'm like, oh crap, what do I do? And that's where I found the operating system that we implemented, and tried to implement it myself for a good 1.5 years. I did it, but again, I'm not an operations person. So, a non-ops person trying to implement a business system in an existing company is not easy. And that's when I found Rise and got some implementation assistance from somebody to help me kind of really roll it out properly. So
Nice.
Yeah.
So I know I kind of lost track of time. My timer
good,
went
man.
off.
We got
but-
probably 10 cuts in this thing anyways from all the glitches. So we're probably only been talking 20 minutes, but
Well, I do want to respect your time though, because I know you're busy and you're on the East Coast. So what's that, 7:00 right now? So
it's dinner time, but it's all good. I'm having fun with you.
nice. So, well, how can people get in touch with you? Well, what's your contact? You did mention that you do have coaching, but yeah, if you can share that, and so we can at least put that up on the screen when we put this out.
Yeah. So a couple different people would probably want to reach out to me. If you just want to know the basics of mobile home parks, which obviously you're in the right place because you're listening to this show, connect with me on Instagram, Mario Datillo TV, and you're going to get a ton of content, learn about what I'm doing. But if you want to learn how to actually invest in mobile home parks and do it the right way with hands-on coaching and deal reviews and partnership stuff and all that craziness, check out getrealcashflow.com. That's for the serious people who are really trying to get into it. And really, I mean, if you're already in the business, I'd love to partner with people. I love to, infill or sell off the homes in your community through my dealership, whatever. You can find me. Just connect with me on Instagram. It's probably the easiest way. But this has been a lot of fun. You guys are doing a great thing with this podcast. I love what you're doing, and you're adding a ton of value to new and experienced investors in this space. So it's really been a pleasure to hang out with you guys for an hour. It actually just feels like we've been hanging out. It really doesn't
Yeah.
feel like an interview or anything. And hopefully I can help you guys in any way possible as well. So love what
Yeah,
you're
for
doing.
sure. Well, we do appreciate you coming here, sharing all the knowledge. Again, I think we're going to name this show the upcoming opportunities with the recession, something like that. But yeah, thanks for sharing the nuggets and your experience and letting us get to chat. Like I said, we don't want it to sound like an interview. We just want to have a fun conversation with someone that's
has
cool,
been.
doing cool stuff in this market. So
It has been. Yeah, it's
But-
been fun.
Really
cool,
appreciate it.
Mario. We do appreciate you, and we'll let you get on to your dinner at 7:00 in Florida right now. So thanks again for coming on to the show and sharing with everybody that's watching.
Sure. Thanks, guys.